Good morning, everyone. Welcome to Windsor Brokers live daily market outlook for Friday, 30th of November 2012, last day of the week and the last day of the month of November, and then we're entering the last month of the year with a lot of uncertainty still seen in the market. Yesterday, driven mainly by conflicting news, with of course main focus being on the United States and the so-called fiscal cliff. Results was on yesterday. Basically, the cold water was poured over the investors, and the sentiment, especially affected the euro, was affected by this after comments from the US officials that again they are getting more far from the agreement between Democrats and the Republicans, and this resulted basically yesterday in a sharp dip in the euro. But the single currency still stubbornly holds its positive momentum that resulted this morning in a brief break above psychological and important point at 130.00, even extending above 130.20, our initial barrier. But still we don't see the clear break above this. A lot of conflicting news, as I said initially in the morning, were more positive tones coming from America, and then afternoon came something completely opposite, and still the markets are still in the sort of choppy mode, and still without clear decision, although some, as I said, the euro holding and the other currencies holding their momentum, and it seems that euro is poised to clearly break above 130.20 in order to confirm the bullish stance of 126.60 and for a possible final test of levels above 131. As said, the House of Representatives speaker said yesterday that fiscal cliff talks with the White House had made no substantive progress, and criticized President Barack Obama and Democrats for failing to get serious about including spending cuts in a final deal. Recall yesterday's comments of yesterday published comments from President Obama, saying that the deal likely to be reached by Christmas. It's now conflicting with the current comments of House of Representatives speaker that said that basically accusing the president and his party for obstructing the negotiations. He said he's disappointed, and all disappointed in what happened over the last couple of weeks, as no substantive progress has been made in talks between the White House and the House over the last 2 weeks, and there's been serious discussions of spending cuts so far, and unless there is a real danger of going off the fiscal cliff, that will be actually the disastrous scenario for the United States, as that this will bring the biggest world economy into recession. We believe that what President Obama said on Wednesday, that most likely the deal will be reached, will be the likely scenario, as said, consequences of failing to do so could be quite bad and not affecting only the United States, but worldwide, and the further deepening of the current crisis that is already shaking the whole world, and especially the biggest economies, could widen, and that will be signal for a further step back in past 2 years attempts to improve the situation that was hit initially by 2008 and 2009 initial crisis, and then a brief recovery was seen during 2010 and 11, and now in 2012 the crisis broke out again. Back to our markets. As said, euro is holding its positive momentum, and the brief break above 130 is still holding above there. Of course, we have to see the weekly close above these levels in order to confirm the positive stance. Probably 131 to be cleared, and then we will be on the right track towards 131.70, 131.38 double top posted in September and October. While sterling is again attacking at 160.50 previous double top, yet no clear break despite a brief lift above this level to 160.60, with the dollar yen being again on the track towards full retracement of corrective 82, 83, 81, 68 pullback, with the levels above 83.60 seen so far. Dollar yen is sinking lower. Fresh low posted this morning at 92.45 en route to 92.13 key support. Crude oil is still holding positive as yesterday's action broke above our initial barriers at 88.50, posted high at 88.67 so far ahead of corrective easing. Still the tone is biased slightly towards the upside, but still a regain of important 89.20, 89.77 barriers, and the regain of 90.00 is required to confirm, while gold is recovering well. It's basically attacking our break point at 17.30, reached so far 17.31.60. This is the broken bear trend line, and the previous high that is basically required to confirm the recovery from 17.05 yes, 2 days ago low is back, bringing bulls back in play for a possible attempt again towards upside barriers 17.38, 17.46, 48, and 17.52 recent peaks. From today's calendar, as it is Friday, we can see. Wow, it seems that we have a problem with the calendar. Wow. Allow me for a second just to change the calendar. It seems that there is a technical problem with the calendar. Meantime, you can take a look at Euro's picture until I change the calendar. Small problems. I think I can fix it from here, so we will just have a right view. I do apologize for this inconvenience. It lately happened. We're planning to introduce a completely new calendar built up by our IT guys, and it's still under preparation. So unfortunately, we have to wait for a while until the thing will be ready, and then I hope we will not have these problems anymore, and it will be much more easier for all of us to view as a new calendar designed by Windsor's experts will contain all the necessary data and the releases that are important for every trader's decisions. If you allow me just for another few seconds, I think I'm on the right way to complete this thing and fix the calendar accordingly. Instead of calling someone for help, it's going to take us too much time now. We're going to fix it. The operation takes some time, as I can see, but the progress is evident. Okay, I think we're back to, yes. Okay, once more apologies for this, and we're going to take a look quickly on today's calendar. I think you can see it now. Okay. As said, the latest release was Germany retail sales that came at minus 2.8, quite disappointing result in October compared to plus 0.8 in September, and slightly negative forecast at minus 0.3% at that was released at 7 o'clock GMT. COF economic barometer came out from Switzerland. Unfortunately, we don't have it updated. Obviously, I didn't manage to fix everything, but I will give you the result in a while. Meantime, important still to come is economic barometer in Switzerland came at 1.5 compared to 1.61 and 1.67 forecast in the previous. So again, lower than expected in November, and of course lower than October's release. And then we have the data from Eurozone at 10 o'clock GMT, November unemployment rate that is again forecasted to tick higher to 11.7 compared to 11.6 release of month of October, with the flash estimation for the November inflation seen at 2.4% compared to 2.5% in month of October. Data from US start at 13:30 GMT. Personal income and spending decrease in both in October, seen 0.2% is the personal income compared to 0.4% in the September, and the personal spending is expected more significantly to drop according to the forecast of 0.2% compared to 0.8% in the pardon, the month of September. And the Canadian GDP for third quarter at the same time, 0.1% slight improvement seen on the forecast for third quarter compared to contraction by 0.10% in the second quarter. Chicago PMI for November is due at 1445 GMT, and improvement from the negative to positive zone from 49.9 in month of October, seen forecasted at 51.2 in the month of November. Reminder that below 50 is contraction and above 50 is expansion of the economy. And that will be all from today's calendar. Now, not to waste time, we already lost some time with the calendar. Let's take a look at the markets and see the latest movements. As said, driven by contradicting news. Yesterday, the euro dipped after touching 130.12. Yesterday, brief break was seen yesterday in the afternoon during the US early hours. But then again, the cold water came. This is what we mentioned earlier, that House of Representatives Speaker said that they are still far from the agreement and decision, and the euro dipped as low as 129.43. In our yesterday's written analysis, I mentioned that 129.48, this was the low of the day yesterday, should be containing any stronger dips, pointing 129.70, as initial supports were expected to be contained. Unfortunately, quite a negative sentiment was built up on the negative news, and the pair dipped to our breakpoint support, where the 55 days ascending 55 days exponential moving average contained the dips, and the fresh momentum again has been built up, with resulting in the break this morning above these levels, 130.26. This is equivalent to a 76.4% retracement of 131.38 to 126.60 descent, along with the 130.20 double top of 25th and 31st of October. Now, this is the basically barrier that we need to see cleared in order to confirm the current bullish stance. Still hesitation seen at these levels, but so far the pair holds above 130.00, with the, of course, releases, economic indicators, especially those from Eurozone, going to have some impact on the single currency, especially the unemployment rate, in case it comes slightly higher than expected or negative as expectation is, with the more pessimistic forecast compared to the previous month release of the unemployment in the Eurozone, could be another factor of delaying current rally. But main focus is still on the United States and their negotiations about solving the problem with the fiscal cliff. And basically this is most likely going to be one of the main drivers of the single currency, along with the technicals that are positive at this moment. As we can see, we are in the hourly chart, the structure is positive. On the 4-hour also, the fresh momentum that is building up on ROC 14, where the indicator broke above the midline and holding above 7 days moving average, and the momentum of 22 days is emerging higher, as MACD is also gaining pace, and the RSI pointing higher, approaching basically the overbought territory, but still pointing higher. This is avoiding immediate risk of stronger reversal that was yesterday signaled by a bearish divergence on MACD on the 4-hour chart, and basically break above, clear break, sustained break above 130, 130.25 is required to confirm the bullish stance. Of course, the weekly close above 130 could be another supportive element in the current rally that will signal that 131 that is currently looming above the prices in the near-term focus. Below this, we have 130.87, the tentative bear trend line connecting 131.70 and the 131.38 peaks, and that will open way again towards our key barriers, 131.38, high of 17th of October, and the 131.70 peak of 17th of September 2012, and basically will signal resumption of the larger and broader uptrend of the single currency from 24th of July 2012, low of posted on 24th of July at 120.42. Resumption of the broader uptrend would be a signal for a fresh extension higher, and basically now the pair is attempting, as we can see on the daily chart, on the weekly chart, it's attempting through the main bear trend line drawn of 149.38 2011 peak posted on 1st of May 2011, and this is currently standing at 130.20. This is very strong barrier also, and break here is to reintroduce levels at 131.38 and 131.70. On the downside, immediate support lies at 130.00, 129.90, reinforced by ascending 20 days exponential moving average. The next comes dynamic support at 129.67, 55 days moving average, also 129.68 yesterday's intraday low. More significant is currently doubled bottom seen on yesterday's low at 129.43, and also yesterday's low. This is the daily low of yesterday at 129.38, and the intraday low at 129.43. Break of these levels only, I would say, would more significantly affect the current positive structure, and most likely signal bulls will be put on hold in favor of a deeper reversal. Otherwise, we keep the bulls so far firmly in play, and expect to see daily and weekly close above 130. That will be quite supportive point for the single currency for possible rally through 131.00 towards 131.38, 70-hour key upside barriers. Sterling is also attempting through 160.50, 55 previous highs, with 160.60 seen so far. Again, hesitation seen at this point as a quick dip lower reached 160.41, but overall tone is still positive as shown on the hourly chart, although a bit sideways movements seen on the hourly indicators, while 4-hour ones are more optimistic at this point, if we say it this way, as all indicators are pointing higher, and yet no any signal of reversal despite the stochastic being already above the control line, and the looking for reversal, yet we don't see anyone. MACD starting point higher, and all the others, ROC 14 and the momentum 22 days are pointing higher, seeing room for a fresh extension higher, with the gains so far being limited by upper Bollinger Band of 20 days. Widening Bollingers again, as we can see on the 4-hour chart, are seeing as support, are seen as a signal for a fresh action, and a possible clear break above 160.50, and probably weekly close above this level is to reintroduce another important barrier, 76.4% Fibonacci retracement of 161.74 to 158.26, and the psychological and round figure barrier at 161.00. That is seen intact in today's action, I would say, but good thing will be approach and the weekly close above 160.50. That will keep the positive momentum of 158.26 recovery, 158.26 low of 15th of November, and the signal of extension of the near-term recovery from this level towards 160.100, and at later stage we have another important barriers, 161.74 and 161.78, double tops of 17th of October and the 1st of November 2012. Back to the near term, immediate support is at 160.40 this morning, slow, reinforced by a 20 days exponential moving average. Dynamic support 160.27, 55 days one, and more significant at this point is 160. These are the yesterday's lows, a break of which would again signal that 160.50 is acting as a quite tough barrier. Of course, to confirm bears back in play, we need to see a loss of 159 60 yesterday's low. That will again revive bears and probably shift the near-term focus towards the downside. So far, bullish action and denting that dented the 160.50 sees more focus towards the upside, and the possible test of 160.92 and 161.00 are seen as the near-term likely preferred scenario. The dollar yen is poised to fully retrace the recent corrective action, better shown on the 4-hour chart, from 82.83 to 81.68, where the ascending 55 days exponential moving average limited dips just below 23.6% retracement, and the fresh strength now underway. So far 82.67 seen. This is basically the last barrier at 82.61 has been cleared en route to 82.83 for possible resumption of the uptrend from 79.06 low of 9th of November, and then focus towards our next upside target at 83.00 psychological barrier. Improved, basically the improving 4-hour indicators, 4-hour charts indicators that are all now pointing higher and emerging above their midlines, see room for this stretch through 82.83 towards 83.00 and probably for extension higher, while warning comes from the overbought hourly studies. Yet no any reversal signal, but this could give us suggestion that gains might stall or might hesitate on approach to 83.00 in favor of some I would say rather consolidative rather consolidative than corrective action. Certain hesitation could be seen as RSI is already in the overbought territory and MACD is quite extended, while momentum started slightly to point lower on the hourly chart. Yet no more space seen on the stochastic as it is again pointing higher. We might see some pause in the current rally due to the indicators on the 1-hour chart being overextended, but overall picture as shown on the 4-hour indicators that are all pointing higher sees room for a fresh extension higher in the test and possible break above 82.83 and 83.00. That will introduce again levels on the upside at 83.29. These are the highs, 83.29, 83.38 of April, March 2012, and then another important barrier is 84.17 is the yearly peak of dollar yen posted on beginning of March 2012, as the pair broke above 150 days weekly moving average that's currently at 82.25. More prospect is seen towards the upside as the weekly 200 days moving average is now starting to point to move sideways. That could be a signal for possible stretch higher and the full retracement of 84.17 to 77.12 slide seen from beginning of March until the beginning of September in 2012. And finally, from currencies, dollar Swiss that is losing traction remains in the down move, as on the hourly chart ADX shows that bears are back fully into control. Following a fresh low posted this morning at 92.44, marginally lower low from the previous ones. We had series of 92.63, 53, and 92.51, and this one 92.44. Still focus fully remains at the downside, and our key support at 92.13, low of 17th of October 2012. While corrective action has been maintained, corrective actions, have been maintained by descending 20 days and 55 days moving averages. The last one yesterday was capped at 93, also psychological resistance, and just short of 93 at 92.97, ahead of fresh acceleration lower. Any improvement in the current structure requires a regain of first 93.00 and a more significant 28th of November corrective peak at 93.39. That would provide a temporary relief for the pair, and this is approximately close to 38.2% Fibonacci retracement if we consider today's low as the stable one, and close to it is also the descending 55 days moving average currently at 93.29. So break above, I would say 93 40 50 zone is required to provide near-term relief and prevent the pair of possible slide down towards 92.13. From the other side, as all the studies are still pointing lower, especially both lower and the higher time frame studies are pointing a lower break below 92.13, 92.00 as psychological support would be a signal of end of approximately 10 weeks congestion, sideways range trading, consolidative action that was limited on the downside by 92.13, on the upside by 95.11 as a part of the larger downtrend from 99.70 peak of 24th of July, and they basically break below 92.0013 to signal resumption of this downtrend, and open levels 91.50 and 91.00 as seen as the next downside target in the case of break. Failure to test 92.13, and especially in case of a break above 93 40 50 zone that I mentioned previously could delay the bears and signal that the pair will remain for the near term in the current range. And from the commodities, gold is basically now in the recovery mode of 1705 low posted on 28th of November, better seen on the hourly chart. Initial loss of momentum and the acceleration lower, again driven by news from United States, has been contained at 1705. This is quite good support, as several previous attempts have been contained there, and the latest one also. So recovery is now on the right track for a possible regain of our barriers 1735, 1738, and 17 Fibonacci barriers 1746, 48, and the recent peak at 1752. As the gold is currently attempting through 20 and 55 days moving averages. I think we mentioned yesterday in our comments that break above bearish crossover of 20 over 55 would be initial trigger for a possible regain of 1735 and 1738 levels. Still for our indicators are still in the negative territory, and I would say lacking momentum at this point. Most of the indicators are negative still, and we still see risk on the downside despite the current recovery. A failure to clear the moving averages would be the first point of signal of weakness, as also this level marks approximately, I think 50% exactly, around 50% retracement of the down leg from 1752 down to 1705, and the failure here could result in the fresh leg lower. From the other side, the hourly studies are in a way losing momentum despite the brief break above center lines. Lack of momentum to sustain gains is now evident, as momentum is pointing lower and stochastic already reversing. This could signal the further hesitation on approach to 17 for a firm break of 1730 and approach to 1735, 38. As said, unless we see the gain of minimum 1735, risk of another corrective action is quite high, as 1724 and the 1717 are seen as the good supports. In case of losing these levels, the downside will unfortunately come again into near-term focus, and probably revisiting 1705. Now, a lot again depends on the news that are the main drivers of the markets, especially today, that is end of the week, and should be some covering of the position could trigger some stronger movements in the market. And finally, crude oil, we said briefly, pardon, already we said that it has regained some important levels, 88.00, 88.50 on a stretch to 88.67, but it seems that at least on hourly chart, bulls are losing their traction, while for our bullish action is still fully in play, and probably to look for a retest of 88.50, 88.67 recent peaks. Hourly studies are weakening, although holding in positive territory, but all starting to point lower, with the stochastic now reversing and momentum again below the midline, seeing not lack of strength at this point. 4-hour indicators slightly improved, but unless we see a gain of minimum 88.67, further sideways movements could be likely, and the downside would remain vulnerable with the dynamic supports at 87.47 and 87.33, with the bullish crossover here so far underpinning the advance, as the dips were contained at 87.46, also 20 days exponential moving average. A break below these levels and loss of 87 as psychological and round figure support could again reintroduce near-term bears and turn focus to the lower boundaries, where we have good supports at 86. Previous supports now still acting as again as supports at 86.36, 86.16, 86.00, and the low of 28th of November at 85.35. Basically nothing significant happened with the crude oil, as the price is still entrenched within the 84.05 and 89.77 range. As I mentioned in past a few sessions, unless we see break above 90.40, that is also Fibonacci resistance, not much of action to be expected. On the downside, of course, a loss of a recent low at 85.35 posted 2 days ago. We'll look for the possible test of the key support at 84.05, while on the upside, the regain of 89.20, 89.70, and more important 90.00, 90.40 would shift the near-term focus higher again. That was all from my side today. I think I spoke enough. Now it's your turn. If you have any questions, please, you can submit them now. Except thanks and good wishes, do we have anything regarding markets? Or perhaps we covered all important points. Let's take a look on the euro-yen, as it seems to me, despite there is no question about this, but it seems to me quite interesting, as the pair is again regaining strength. Let's just take a look on the charts. The pair has broke above the previous high at 107.12, so far 107.60. Seen extension of the uptrend from 100.32 low of 13th of November, interrupted by corrective dip to 105.26, where the 55 days exponential moving average contained the dips, and fresh strength. It is now looking for a test of basically we cleared also the 107.33, the 76.4 Fibonacci retracement of the larger down leg from 111.42 down to 94 pardon 10 would break above 90 days moving average and the 76.4 Fibonacci retracement, seeing the next barrier at 108. This is high of 15th of March, pardon, April 2012, and basically nothing is left on en route towards 111.42. A positive tone that dominates on the larger time frames, although quite extended the daily studies, but no signals of any reversal yet, while the 4-hour indicators are now building up positive momentum, approaching also the overbought territory. We might see some corrective consolidative action on approach to 108, but overall positive tone remains fully in play. As long as I would say the 105.26 stays intact and contains any stronger dips, more focus seen towards the upside with 108.00 break of which to open way towards 111.42 yearly peak. And I think we have exhausted things for today. The Arabic session will start in a few minutes, so we have to leave some space for my colleagues. Thank you all for being with us. I hope and believe that we provide you good quality of information important for your trading. I wish you nice Friday and good successful trading today, and of course very nice and relaxing weekend, and we are back on Monday at our regular time at 8 o'clock GMT at the beginning of the new month. I expect to see you all again. Thank you and good luck.